Hello and welcome again to another quarterly update. Joining me is Dr. Steve Garth, the consultant to the APW Partners Investment Committee. Steve, welcome.
Thank you, Jeff. Great to be here as always.
End of another quarter and not long to go, end of the year. Looking back on the September quarter, it seems to be the only constant is the unpredictability of financial markets.
Most people have already forgotten this, but it was only about 8 weeks ago. Markets had quite a big downturn. The NASDAQ over in the US was down by more than 10%. In fact, I've got a chart here showing volatility in the US. And that spike you see at the start of August, that's the third biggest spike in volatility in history. It was all about some economic data out of the US, which really spooked markets. They thought we're definitely heading into a recession. The Federal Reserve have been too late in dropping interest rates. But it really only lasted a few days, as you can see, and then markets started to crawl out. And of course, we've sort of ended the quarter with an air of euphoria in equity markets. US market, you can see there, it's up over 35%. NASDAQ market again doing really well, over nearly 37%. These are new highs for the market. So market, any thought of a recession seems to have gone out the window at the moment.
It seems like the old saying that yesterday's news is tomorrow's fish and chip wrapper is never more appropriate.
That is so true in this case.
So if we have a look at the Aussie market, of course, we know that's dominated by the banks and the mining stocks. The mining companies have tended to languish for quite some time, and the banks have seemed to have had almost a license to print money, but that's changed a little bit during the September quarter.
That is absolutely right, but it's only just changed in the last week. First of all, looking at the ASX 300 overall, it's a great result. We're up nearly 8% for the quarter and up over 21% for the previous 12 months. So being in a diversified portfolio of Australian shares has been a great outcome. But to your point, Jeff, if we break that up a little bit and look at the two major sectors that make up the Australian market, that's financials, our big banks, and resources, that's the big miners, you can see this dispersion that we're showing there over the year. In fact, up till about a week before the end of the quarter, that dispersion was as wide as it's ever been. So what's happened, you can see the change there in the last couple of days of the quarter. It's all got to do with policy coming out of the Bank of China, which is trying to lift their economy, which has been in the doldrums for ages, and particularly lifting their real estate sector. Now, their real estate sector is one of the largest consumers of iron ore. Iron ore is really one of the major products that our miners sell to China. So you can see in this other chart here how that policy statement coming out in the last week of September, the Chinese stock market has shot up by 20% since that. And with that, iron ore shot up by 10%. So that's what's lifted up the resource sector.
You mentioned the Aussie market doing very well for the quarter. In fact, it was the best performing market globally for the quarter.
Yes. If you're surprised by that, it's really because we've got a very small tech sector. So when that volatility spike hit back in August that we talked about, it really hit the tech sector most of all. And of course, the US has made up more than about 30% in the tech sector.
I guess the Aussie dollar appreciating against the US dollar has probably helped those numbers along a little bit.
It has. There's a couple of things going on there. Number one, the US has started to drop their interest rates, and therefore the differential in rates between the US and Australia is smaller. That gives a boost to the Australian dollar. The fact that we've just seen iron ore bounce up, believe it or not, the Australian dollar is actually quite correlated to iron ore prices. So that's given it a boost up as well.
So you mentioned the US cutting interest rates by 0.5% or 50 basis points. There were some questions as to whether they would go that hard, but it certainly charged the market and helped bonds along.
Just on your first comment, when the Federal Reserve first dropped by 50 basis points, I think it confused the market because they thought, are you seeing something that we're not? We're expecting a 25%.
Should we be panicking?
Yes, there was, again, I mean, equity markets are panicky by nature, but I think they thought, why is it 50 basis points? But everything seems to be going quite well in the US from an economic perspective, and I think the markets now thought that's great. So as the interest rates get cut, the yields come down. As yields go down, bonds go up. So you can see in the chart we've got here, Jeff, it's sort of a quarter by quarter show of how the bond market's behaving. Now, yields are quite volatile. They're just not as volatile as equities.
Yeah.
And they typically work differently to equities, but you can certainly see that in the last quarter, particularly as those US yields have come down, then we're getting a return of an overall return for the year of 9% for global bonds and around 7% for Australian bonds.
Yeah,
So,
and getting up around nearly half of that in the September quarter alone.
yeah, absolutely. It's all been happening with that fall in rates, and even though Australian rates aren't dropping soon, there's certainly the expectation that, by next year we'll start to see the rates come down. Bonds are now doing what they're meant to do in the portfolio. They're providing income, but they're also providing that defensiveness. There's room for them to move, to go down lower should anything happen in the market.
Again, a really good illustration of the importance of not making knee-jerk decisions around portfolios and any changes that are being made. So being alert, not alarmed is probably the key.
Alert, not alarmed. That is exactly what we have to be.
Well, look, once again, Steve, thank you very much for the update on the ups and the downs in the September quarter. It's looking quite solid at the moment, and we hope that will continue for some time to come. For those who are joining us today, thank you very much once again for your time, and we look forward to seeing you on another quarterly presentation. Bye for now.
Thank you. Thanks.